I guess you just got to start. Deepak has
Yeah.
joined, I guess. That's good.
Hi, Deepak. So we'll kick things off. Good evening, everyone. Welcome to the third session of the Capital Conviction webinar series. I'm Dipit Gupta, an associate at Phenomenon Investments, and your host today. Thank you for taking out time on this Wednesday evening to join us. Capital Conviction webinar is created for one simple reason: to cut through the noise and bring fact based, no hype insights into the most important capital allocation decisions. These include planning investments, taxes, estate, mortgage, insurance, among other personal finance topics. Whether you're building wealth for your family, looking for passive income, or just sharpening your due diligence process, this webinar series is designed to help you approach capital allocation decisions with clarity and high conviction. For those of you new to Phenomenon, we are a fee only registered investment advisor based here in Washington, built on the principle of transparency and client obsession. We serve corporate managers and executives as a family office, providing personalized financial planning and investment management services. Now, I'm thrilled to welcome our guest today, Chad Leesburg, who is a loan consultant with Loan Depot, where he has spent more than 2 decades guiding clients through the mortgage process. With a degree in finance from Western Washington University and 24 years of experience in banking and lending, Chad brings both technical expertise and a relationship driven approach and has served more than 100 families and facilitated over $100 million in mortgage financing. Chad is also a partner on the Phenomenon Family Office Network and has served many clients. In the next 60 minutes, Chad will help us unpack how to evaluate your mortgage through the lens of financial flexibility, opportunity cost, and overall balance sheet strength. And after the presentation, we'll have the Q&A, so feel free to note your questions along the way. With that, I'll pass it over to Chad for the presentation.
Thanks, David. Yeah, let me share my screen here. Likes to be pushed twice. Okay, hopefully you can see that. As David mentioned, I'm with Loan Depot, and I've been in mortgage for 13 years and based in Snohomish, Washington here, but I'm licensed in 5 other states, including Oregon, California, Arizona, Texas, Hawaii. And I graduated with a finance degree from Western a long time ago and have been in banking and finance ever since. And spent about half my career in banking, commercial finance, and really enjoyed that and decided to make a transition out of that during the financial crisis. Just thought I would like to try something else, and mortgage being a good, you know, tangent industry. It made a lot of sense. And I live in Kirkland with my wife and 2 boys, and I have been a landlord for about 20 years and have a lot to share about that. We won't go into that, but if you have questions about that, we can talk about that. So our agenda for the next hour, let's trying to kind of avoid a first-time homebuyer feel with this one. I've done a lot of first-time homebuyer courses over the years and kind of do a little bit deeper, not too nitty-gritty, but a little bit deeper and touch on some of the biggest topics right now affecting borrowers and the industry. Credit reporting, top pitfalls, what's going on with interest rates, how we look at down payment sources and income sources, what you can do with that, and then kind of the hottest products, the most useful products right now, and talk about refinancing and largely how that might tie in with adjustable rate mortgages. Could be a bigger aspect of refinancing for probably right now, starting with adjustments on adjustable rate mortgages. So credit reporting, that's just a very rudimentary illustration of what goes into FICO, your credit scores. There's 3 credit scores, 3 credit bureaus, and each one of them formulates the score a little bit differently. If you've sure had experience with that, but they're not typically the same. Sometimes they are, but almost always they're going to be 3 different scores. You can maybe get somebody to kind of talk to you in our industry if you don't have your credit pulled, but it's really best to have your credit pulled. People still often ask about, the impacts of pulling their credit and seem to be kind of worried about that. It really is not a big deal. It's going to affect your score very minimally, like maybe a couple of points just from pulling it for a mortgage application. And credit reports are good for 4 months. So even if you don't end up purchasing something or refinancing or whatever, if you need to refresh your credit in 4 months, the effects of that, so much time has passed that the effects, like the cumulative effect, it's going to be just non-existent. So it's not really going to matter. You're obviously not going to want to pull your credit every 3 weeks and do that, because that will decline your score. So maintaining a pre-approval and shopping for a mortgage is really not going to reduce your scores. And with that, we also will hear a lot of mortgage companies are doing it now, but especially here, we will just do a soft credit pull. If you're going to get pre-approved, we'll just do a soft credit pull, and then that doesn't affect anything at all. You don't even know it's there. Obviously, we get your consent, but we just do the soft credit pull and utilize that until you're into contract. And once you're in a contract, we're going to want to do a hard pull just to make sure that there's nothing kind of hidden there. There shouldn't be any surprises, but we operate that way. So there's really, until you're getting in contract, there's really no impact to your credit at all in working with us. So pitfalls for mortgage and the real estate industry. I'd say the biggest thing, not many people do this now, but since I've been in mortgage, people would often just not get pre-approved. They start shopping. People, I think, have kind of finally gotten the message, and you don't see much of that. Maybe real estate agents see it if people come and tour a property and they haven't gotten pre-approved. But if someone has a real estate agent and they're shopping, most of the time they're gonna be pre-approved. But obviously, that is like the top thing, is get pre-approved. It's not going to damage your credit. You're going to want to get on the front end of planning. If there is something in your credit that you want to, that you don't even know that you need to, but you want to deal with, then time is on your side in doing that. And I can coach you. We have a lot of tools in that. So you want to be proactive in getting pre-approved. And then this one doesn't necessarily affect me, but not using a real estate agent, people do often have interest in doing that. That's not smart. Different states have different processes, but locally here, you're always if you're buying, you're always gonna want to. I would advocate on the sell side too that you're gonna want to use a real estate agent, but especially for a buyer, you're gonna want to have their representation. I myself, I can deal with contracts. I've been doing it. I've purchased real estate without using a real estate agent, but that was just unique situations. And on my last home purchase a few years ago, I did use one of my top agents, even myself. And it's like, you want that protection. And there's also just the interaction with other real estate agents. It really does make a difference. Focusing only on interest rate. Of course, it is a huge thing. It is important, but people, I think, do themselves a disservice by really just being hyper focused on interest rate. You want to, my opinion is like, you want to get a good interest rate, but you don't want to go chasing the lowest interest rate that you can find on the internet, because this is a profession, lending, and it's not all the same. You don't want the service that comes with that lowest rate out there. So I would definitely caution against that. Making financial changes after you've found the home, and after you've been pre-approved, let's say, and you find the home, you're into contract. Obviously, don't go get a new car loan or anything along those lines. People do still make that mistake, not necessarily with me, because we'll coach you in the pre-approval to not do that, but that does happen out there for borrowers. You're not going to want to make any changes. If you have questions on that, come to me, come to your lender and ask them, because it could be something that's completely benign and you can proceed with. It's like, a common thing is someone will ask me, oh, can I go buy some furniture for the new house on my credit card that I already have with more furniture or whatever? It's already an open account. That typically is not going to make a change to your credit score. It's not going to affect your debt to income, but that's a great question. But do not open new accounts, even if it's a credit card. Like, don't do anything that's new to your credit. And then, I don't know if most people in this business would say this, but I think a huge thing is taking into consideration what your next purchase is. Even if you're a first-time home buyer, consider, and that's something that we'll talk about in the pre-approval initial consultation, is, what is your plan 3 years down the road, 4 years, 5 years, and think about strategizing for savings for the next purchase. Also, if you're going to convert the proposed purchase into a rental in the future, how that could impact things. I had a client this year that she was a past client of mine, first-time buyer back then. I helped her with her first home, and that was like 6 years ago. Then she was doing pretty well. She had, I think it was $100,000 that she wanted to apply to her current mortgage, and she said that she was going to purchase the next home soon, and she's not wealthy, say like just typical buyer. And I knew that it would make a huge difference when it came to the next purchase for her to have that as a down payment versus applying it to an existing mortgage. And I pleaded with her to save the money and put it into a CD. I went and used my banker, and I said, here, I showed her, I was like, put the money in the bank, put it in this 6-month CD, and it will be a huge difference for when we go to buy the next place for, I think it was like $700,000 or $800,000 to qualify for that. She didn't listen, and she paid down her current mortgage. And there's ways to kind of undo that. You can borrow it again, do a home equity, but that was the other part of it, that she had a 2.8% interest rate on that other mortgage. So that was just a really dumb use of capital to apply it to a mortgage. So you're borrowing historically low rates and then turn around and borrow those same dollars on a new purchase at 7% at the time. So really need to think about those things. Time, okay. So interest rates. We are, I guess we're still feels like we're kind of in the beginning of the decline of interest rates. We saw 30-year average mortgage rates tick over 8% a couple years back. That was awful. And it was a very, very aggressive climb to that, kind of coming out of COVID. I think we hit like 8.1%. And on the slide here, that's prime, that's unrelated to mortgage rates, but prime also, just funny enough, prime also topped out at 8%. And then if anybody pays attention to the Federal Reserve announcements and the way that the media likes to focus on that, we have seen Federal Reserve reductions. We saw last November just a quarter point. There hasn't been substantial reductions. There's all sorts of different opinions on that. You know, if we see half of a point or a full point reduction, and I never personally, I'm not an economic, I'm not an economist, but I didn't expect more than a quarter of a point. We did see that the past 3 reductions, and our prime is now at 7.25 as of last month, a month ago, and we will see another, I would guess, at least a quarter point reduction this year. Give it probably a 50-50 shot that we'll see maybe another reduction, or we'll see a cumulative reduction of a half of a point in prime, which is directly controlled by the Fed, the bank overnight rates, and the prime rate. They control that. They do not control mortgage rates, but they run in kind of in tandem. It all affects we're all existing in the same economy, and we have seen mortgage rates come down from that 8+ to we're now today the national average is 6.27%. So we've come down a lot, and that's really helped with a lot of different things. But people are refinancing now, especially if you purchased something in the past couple of years. If you were at that, high 7s, 8%, but we are still seeing the effects of the very aggressive inflation that we had coming out of COVID, and the tariffs are having, a large effect. We're kind of we're seeing, especially just last week, we're seeing kind of counterbalancing with along the lines of tariffs. China, we're seeing enough concern with the rhetoric, I guess, the financial rhetoric, especially with China, where we saw, I think it was on the chart, you can see, if my cursor's on that, the large candlestick, that was October 10th, where if you look at mortgage-backed securities, you wouldn't see that same movement, but this is the 10-year Treasury, which is the best approximation to mortgage rates. So I'm just using that chart, but there was a lot of buying of treasuries because of the conflict, largely with China. So money flowing into treasuries helps reduce the rates. So that's what you saw happening there. I mean, that was a big day of movement. It didn't translate to lower mortgage rates at that level, but we're seeing kind of, it's not good, but at least you're seeing some counter effects to the, I guess, fears of more tariffs, or seeing the true baked in effects of the tariffs that have already been instituted. A lot of market players don't know fully what those effects are. It takes time to see what that is, the effects on inflation of that. The readings of inflation that the Federal Reserve uses to make their decisions. That's really the big thing. But and we have a stubborn, again, it's a good thing, but it's bad. Unemployment rate, it doesn't help the Federal Reserve to make cut decisions when our economy is as strong as it is still. Next slide. So I want to talk about the big sources of down payment and income. So typically you're going to have somebody that has just saved their money for a down payment. That's pretty straightforward. But I didn't put it on here. You can also have gift funds. That's a common thing. There's no limitations generally on buying a residence. It can all be gift. If you're going and buying an investment, that changes things. But a lot of times people will, even if they have, even if they're let's say if they're a high earner in our local economy, they may have gift funds from family for the full down payment. So that's very common. But as far as your own funds, you can borrow from your retirement 401k. That's really common. Your administrator is going to have different rules on that, on how much you can borrow. Typical amount is 50,000. They'll limit it to that, or they'll mark it at half of your balance up to 50,000. But it's a good source because you can borrow the funds essentially from yourself, and then it's usually a very workable, favorable repayment, low rate and low payment, because we have to account for that payment in your total debt to income. So it's not like it's just free money in the shadows there, but we do have to incorporate it into your application. And then there are down payment assistance programs where it may be borrowed funds that has no payment attached to it from something like Washington State Housing Finance Commission, a very popular program where you can borrow 3, 4, 5% of the purchase for closing, for down payment and closing costs. There's also a pretty amazing program that Washington State just launched last year, and I just got certified, approved to originate those loans, and it's for minorities, different minority groups in Washington. If you can show family connection, residency going back to 1968, you can get up to 20% down payment assistance with very favorable terms on the mortgage as well. So that is a huge thing, and it's if you can qualify for that as a minority group, it's a fantastic program, and I'm excited to offer that. And then people that are transitioning and buying their next purchase, we deal with that all the time. If you're not using a bridge loan, which we can talk about, a bridge loan, or you can just carry both payments, you probably are going to be in a situation of selling your current departing residence. And so we can absolutely incorporate that. But you just have to plan for it and know what it's going to be, and work that into obviously your approval. So that'll kind of cover the biggest things on down payment. And then income sources, probably the biggest distinction in income is whether or not somebody has a salary or if they're hourly. Salary is very simple. We're going to use that salary. Maybe you have sizable bonus income, commission. We're going to average that, but your salary is just set. We get to just use that, which is fantastic. It's the easiest, best thing there is. Hourly is going to be averaged over two plus years, like it was like 23, 24 and year to date. So that it's not scary, it's not complicated, but we have to do it right. And then self-employed income is another big one. I still work with a lot of self-employed people, and that is different. We're going to have to look at more records. We're going to be relying on tax returns, documents that you wouldn't for somebody that's just salaried. But I have a lot of experience working with tax returns and self-employed people. Another thing that we can do that's kind of I would say that it's a growing segment of our business is someone that's self-employed. If their tax returns, for various reasons, probably just because they write everything off, they're not able to demonstrate their income accurately, let's say, on their tax returns. There are other ways to do that. We can do, they say P&L, profit and loss. It's basically an income statement. You can use that from a CPA prepared financials. Or the bigger one is business bank statements. We just look at the deposits, and a typical analysis of that is you look at all the deposits and then you just do 50% of that for most industries. If it's, I just had somebody recently where their expense ratio is lower than 50%. It was like 22%. So we got the documentation from the CPA certifying that, and we're able to use a much lower expense ratio. So they were able to show over 10,000 a month just from their business bank statements. So that was very, very useful tool. And then very applicable to our region is with all the tech employment is restricted stock units. There's a lot of different programs for that, and they all vary on how they analyze stock awards. But the most typical situation you have is that you're going to be looking at, you're going to go back. Well, you go back as far as they are, but you're going to want to see at least 2 years back of the awards, and then seeing that it continues for at least 3 years, which is typically not difficult, but that is how they're going to underwrite that and get the awards scheduled. So that sometimes can be cumbersome with documentation. It's not hard. The math is not hard, but just getting the documentations, but used to helping people with that. Another very useful thing is asset depletion. It's kind of a misnomer. I don't like that really, the terminology, because you're not pledging. It's not pledged assets, and you're not necessarily depleting it if you're using other income for payment on the mortgage. But asset depletion refers to analyzing a liquid asset. Let's say you have $2 million in an IRA. We don't have to touch that, but we can do a simple analysis of that and just often divide it out. So Freddie Mac, one of the housing agencies, their underwriting standard is you can just divide that by 240 months, even if it's a 15-year loan or a 30-year loan, it's just 240 months. So take the total assets, divide it out. There's also jumbo programs that we have. There's different ones, but one that we have now is you divide it by only 84 months, which is just even more beneficial to the income analysis. And then that's your income that we underwrite to. Very useful. You don't have to pledge the assets. There's no transfer. There are pledged asset programs. I've never done those. There are those out there as well, but more difficult. And this is just an example of a very bad situation. This is something I ran across actually in Honolulu because I'm licensed in Hawaii. And we could finance that, believe it or not. Looks like, I don't know that the home was actually up at the street level because that's actually a burned out car there, but the house did burn. That's on the original slide here. That's the interior of that house, but just an extreme example of something that we could finance. We could do a renovation or construction, but we have great renovation products. Maybe people have heard the term 203K renovation. That's just FHA's version of renovation, which is a great program, but you can acquire the home and build in the dollars for the renovation in that all-in-one. There's obviously limits on the loan amount for that, but great option. So that was just the first one here. And we have
Hey, Chad.
Sorry.
It would be great if we could quickly wrap up the rest of the presentation,
Okay.
so we have time for question and answers.
Yeah. I was trying to watch the clock, but okay.
Okay.
Another thing, kind of like asset depletion along those lines, like we can even do non-public stock. I assume SpaceX is still non-public, but if there's a regional non-public stock, we can divide that. We've had success doing that for people that have sizable holdings and something that's non-public. Typically, you couldn't do that, but we can do that. Temporary buy downs on your interest rate. We can fund the buy down from the seller. That's the way it's typically going to work, is the seller contributes funds at closing, and that reduces your interest rate for typically 2 years. It can be 1 to 3 years, but like typical 2 years, where it's for the first year of the mortgage, it's 1% below your fixed market rate, and then, 2% below, and then the next year is 1%, and then on that third year, it comes up to your standard, whatever your fixed rate is, if it's like 6.5. There are ways to do a mortgage where it's the same terms as you purchasing a primary residence, but it can be for a parent or a disabled child. I've done a few of those. It's a great option because you get those same terms as if you were buying it for yourself, because you're buying it for family. Home equity lines with where rates are and where people's first mortgages are. If you're at 2.7% on your mortgage, but you want to do some improvements, borrow a couple $100,000, you don't want to touch that first mortgage. So we'll do a second mortgage. Home equity line of credit is a typical thing for that. We can also facilitate, this is kind of niche, it's like the nichiest of the niche, reverse 1031 exchange. Say someone's going to sell a property, an investment, and they're going to buy a new one, but they haven't sold the old one. We can sold the current one. We could finance the next purchase before they sell the departing, and then it just gets paid off, and it's built into the exchange. Reverse mortgage, obviously, that's something that we do work with reverse mortgages for seniors, and people love it, people hate it, but it is a useful tool. Bridge loans, I sort of mentioned that. We have great options for bridge loans if somebody wants to buy their next home, they're carrying the debt of their current home, and they can't qualify, but for whatever reason, maybe they're not going to sell it yet, and they can't make a contingent offer. But we have ways to do a bridge loan where we can carve out and disregard that current mortgage payment that they're making, and we just analyze it with the new mortgage payment. And then debt service coverage ratio. next slide is just an example of that, where this is for investors where they're not going to look at your person, they'll look at your credit score, but they're not going to look at what your personal debt to income is, your other property. They're not going to look at any of that. They're going to focus on the income generated from the subject property and analyze that alone. And so debt service coverage ratio is that relationship between the income and the debt service there. There are also options with this company. This is with one of our best broker options, Deep Haven. They have an option for a no ratio. So you pay a little bit higher rate, a little lower loan to value, but they're not even going to look at the income analysis of that subject property. So that's pretty useful. And then it's one of our last slides. So kind of the conversation about how do you look at refinancing if you have a super low rate from that you obtained during COVID. And the big question of that is like, when are you going to move? What do you need the funds for? If you were looking at paying off much higher debt, credit card rates are insane. If you got 3% on a $500,000 mortgage, but you're carrying $100,000 and 25% rate debt on credit cards, it could make sense. It depends on the relationship there, but it could make sense to do a cash out and get rid of that super high rate debt, especially if you're going to just be in the home for a few years. You may not carry that new mortgage that long. So that is a common thing that we're seeing, where people are, they're getting rid of that super low rate just to just kind of save themselves from the credit card debt. And you can see from the slide that we're at all-time highs for credit card debt in this country. Luckily, home equity is an all-time high, so you get that benefit. Just what Raymore, just something quickly to touch on this is that ARMs across the country is a pretty low percentage, but here locally, especially for a lot of maybe Visa holders that have purchased, you probably, there could have been a loan program that really benefited you and you're in an ARM that you got during COVID. Those are probably going to be coming up for an adjustment, the first adjustment here, and you could see higher payments because of that. It may benefit you to go into a new ARM, even if you might be in the home for a really long time. It might benefit you just to switch to a new ARM, because the starting rate on an ARM is almost always lower than the fully indexed rate. So once you hit that 5 or 7 years, you're going to go to your fully indexed rate. So you could opt out of that and get a new lower start rate on another ARM. People may not think of that. They may say, "Oh, I need to get into a fixed rate because my ARM is going to adjust, and I don't want that." And I won't talk about that other stuff for time's sake. And that's it for the slides. Thanks for joining us. And those are my two boys living the beach.
Well, thanks a lot, Chad. That was very insightful, grounding, and definitely refreshingly clear. We'll now open the floor to questions. So you can type them in the chat or raise your hand if you would like to come off mute. And in the meanwhile, I also have some questions, some of which that we received before the webinar from attendee registrations, and some that we came up with to the frequently asked questions and overlooked topics in mortgage finance. So I'll get started with them. And in the meanwhile, if anyone has a question, please feel free to raise your hand or write them in the chat. So my first question to you, Chad, would be, when choosing between a fixed rate or an adjustable rate mortgage, how should someone decide? What's the smarter way to think about that choice besides just, which one is cheaper today?
Yeah. kind of like what I touched on is the biggest question here is potentially how long you plan to be in the home. If you plan to be in there a short period, less than 5 years, then going for an ARM, 5 to 7 year ARM is probably going to be your best bet. And you're going to save, typically on an ARM, you're going to save, right now, you'd probably be saving about a full percentage point or more. We have ARMs right now, just was looking at, we're like at 5.5% on a 5-year ARM. Whereas, as we saw on the fixed rate, we're like at 6.25. So that's going to be substantially different, big cost savings. So that would be the biggest thing, is to look at how long you're going to be in the home. It's interesting that over most of my career, the average life of a loan, if you just look at that, if you don't know what you're going to be doing, but just looking at the statistically how long people kept mortgages, for 30 plus years, it was like 12 years that someone would keep a mortgage, it was like 6 years that someone would keep a mortgage. But we have seen that because of the extra low, like artificially low rates during COVID, we're seeing that obviously move up. We knew that it would push the averages up, and we've seen that creep up towards 12 years, that people are now staying in the loan. Maybe they were 6 years into a loan, and then they kept it another 5 years to 2025.
Right.
Yeah.
Yeah. And then one other question that we hear very commonly is, should I pay off my mortgage faster, or should I keep that extra cash invested? How do you help people figure out what's better for them from that angle?
Yeah. The overall rate environment is going to dramatically, dictate the answer on this. You look at average market returns, the opportunity for your dollars versus paying off your mortgage faster is, you're going to obviously look at the simple math of like, oh, if I can go earn 8% in the stock market, but my mortgage is at 7%, like it may not make sense to pay off that debt, and if you can put those dollars to earning more in the market. And it's obviously going to be a real personal decision and tie in with your risk tolerance. But generally, mortgage rates, the past couple years have been special in that we've had such high mortgage rates, but typically you're going to see it where mortgage rates are lower than what you can go earn in, a diversified portfolio that's pretty safe. It's not risk-free, but a diversified portfolio, you're going to earn funds on that versus putting it into your mortgage. And you're earning more, so like just the net difference is positive, but you're also preserving that capital for other things, maybe the next purchase. Like I would say, going back to my comments on really planning for the next purchase rather than putting that into extra payments on your principal and your mortgage, like have it set aside. I'm just a huge fan of that. So I advocate that. I mean, it's like a lot of that's like personal opinion, but I have people that are really nervous, especially in this current environment, where people are being more careful, and I get that part too. So if you're you can buy your peace of mind. If you're just really nervous, you're risk averse, sure, like put more toward your mortgage, but I wouldn't say like pay every extra dollar towards your mortgage. I would say, diversify, like be balanced, really.
Right. Something building on top of this is so people are often refinancing just to get a lower rate, right? But when can refinancing actually be like a smart move to maybe free up cash, reduce stress, or better manage monthly payments?
Yeah, kind of touched upon what's what's happened in recent years on that. Over the past 3 years, people haven't really been refinancing to get lower rates, as rates were climbing aggressively from 2022 to 25, from early 2022 to early 2025. Say they're not typically doing that, but during that same period, we've seen people still refinance to benefit from cashing out and consolidating that higher rate debt. As I mentioned, the credit card debt is just the all-time high. It's really alarming. Maybe adds into
Yep.
people's risk aversion is seeing what's happening with personal savings out there. But it's very easy. We have gobs of tools to look at, where that trade-off is on your blended rate and see if it makes sense. And again, looking at how long you're going to be in the home.
Right. Considering that mortgages usually happen to be like a significant part of like a person's balance sheet, especially if you're a first-time homeowner. So, and life is always happening. Your job changes, family stuff, market moves up and down. So, how can homeowners build some flexibility into their mortgage so they're not stuck if things change in their personal life?
Yeah, that's a great question. Um, There's a reason I typically will advocate for a 30-year, or even, it's not common, but there are 40-year fixed rate terms out there. I am a fan of going with fixed rate, or sorry, not say fixed rate, the longer term loans, because as opposed to a shorter 15 or 20 or even a 10-year, and we'll do 10-year, but a lot of times people are looking at a 15 or a 30-year loan. The difference in that rate you're going to see right now is probably 5.875 on a 15-year versus like that 6.25. It's very, very on a 30-year. And that's not much of a difference. And you're going to have a much higher payment. It's not double, but it's up there. The difference in the payment. Um, I always just, unless someone's really flush with cash, and most likely if they're older, older people will typically opt for that. But for most people, I would really say consider a 30-year, because then you have more control each month. You're not stuck paying that larger 15-year amortization loan payment. You can do it, take the slightly higher rate, and then most months make that payment as if you're amortizing it over 15 or 20 or whatever years. Or you can make you get a large Microsoft bonus, take those funds and put a bunch of that on your mortgage, but don't be backed into a corner on a shorter term amortization loan.
Yeah, that makes sense. Then we're on to our last couple questions. So if anyone has a question, please feel free to put it in the chat. And so the next question I had for you, Chad, was every week we see something new in the news, like buy now before rates go up, or wait, they'll drop soon. And, we recently had the rate cut too, as you covered in your presentation. How do you help people stay calm and make smart decisions when, there's so much uncertainty and the rates keep changing?
Yeah, yeah, like the headlines don't help the situation, especially with interest rates, and you'll see people, um, make bad decisions off of kind of skewed data that's coming out, especially when it comes to the Federal Reserve decisions, and people can just really get confused about how the coming changes in interest rates are going to benefit them, where we've seen a lot of talk about the Fed reducing rates, but most of that, just like anything with like the stock market, if Microsoft comes out each quarter and gives guidance on their earnings release, if it's accurate estimates, then when the earnings come out, there's really little change to the price. So you see that something like that with the Federal Reserve decisions. They're coming out every few weeks, monthly, giving guidance. The market's already adjusting for that. So once they actually make that rate adjustment, it's really just, it's nothing. Like we see typically, it's funny, not funny, but we often see rates tick up, mortgage rates tick up the day that the Federal Reserve drops their rates, because maybe it wasn't quite as good of a drop that the media, largely, I think the media promoting, maybe there's going to be half a point, but then it's just the quarter of a point. So stuff like that. And people also don't execute on a purchase, maybe because of that. They think that the rates are going to come down, or they think that prices are going to come down because rates have been so high. That is a huge one, where people have, specifically my own clients, first-time buyers, maybe repeat buyers, that are just sitting on the fence because they think that there's going to be a value, home value crash because
Right.
of rates.
So rebalancing of expectations, that makes sense.
Yeah.
So we're running short on time, but before I let you go, I have one last question, which is, there's a lot of bad information out there, like how much you need for a down payment or when it's best to refinance. If you had to pinpoint like one thing, what would you say is the biggest myth you wish people understood better about mortgage financing?
Yeah, I would say definitely it's still like down payment. A lot of times people will still think it's like you have to have the 20% saved, and they may not know about all of the programs I mentioned, like the down payment assistance, and even just the standard programs aside from down payment assistance. I mean, you have options for 3% down on a conventional loan, and people are shocked by that they're ready. They're like, oh, I have 3% saved, and they're ready to purchase. And I would say definitely that's the biggest thing.
Yeah, that sounds great. Well, thanks a lot, Chad, for those wonderful insights. And thank you, everyone, for being a part of this conversation today. We'll continue to bring in experienced voices throughout this Capital Conviction webinar series, and we look forward to hosting our next session. You will hear from us on our next topic and guest very, very soon. Thanks for joining us on this Wednesday evening, and have a good rest of your week. Right.